Okay, good day, everybody. This is Jim Kinney for OptionProfessor.com for Friday, the 21st of June, 2019. And I'd like to give you a quick update, but before we do, I'm going to go over a couple things. One is that past performance is not necessarily indicative of future results. And secondly, that short-term trading and option trading does involve substantial risk and loss, not right for everybody. So talk to your clearing firm, your broker, your financial advisor, and your good common sense before you entertain any transaction in anything. Okay, great. Quick introduction. I'm Jim Kinney, graduate, Boston College. Been in the business here for decades. Have conducted hundreds upon hundreds of option learning seminars, both live and online, and basically have educated thousands upon thousands in my career. So, on the uses and risks of how options can work for limited risk speculation, for cash flow strategies, for hedging your market against adverse moves. Okay, I'll get into a few of those things in a minute, but right now, I gave you a little update on Wednesday, and now I'm going to give you one right now. On Wednesday, if you recall, I was saying that the range that I think at this point it makes the most sense as far as a sell zone is between 2950 and 3100, and that's been my position for a while. I'll give the let's get the S&P up here, the index, and I'll show you what I'm talking about here. Move the chart up for you so you can see. All right, so where are you at? You're at 2350 here in December, and the moving averages were where? 2750. So my feeling was we could snap back towards those moving averages, which is exactly what we did. After we got up there, and it looked like it was fairly firm, trading between 27 and 2800, I thought that there might go after the highs, which are around 2950. There's not an exact science on the highs here. You're talking about what? Somewhere in the 2980, 2950 region. And it's gone up there. I think next week is a big week. If we can't take out this week's high and we roll over, this high point we're seeing here could remain intact. Now, again, this week was a big week because the Fed basically took out the word patient, and they made it very clear that if things weaken, they will be more than happy to be accommodative. Some people are throwing around 50-point cuts. Some people are saying we're going to zero interest rates. So the talk is getting a little hairy. But what I do think is that with the relative strength, the RSI, on some of these things like gold, on some of these things like S&P, and some of these things like Treasury notes, that the likelihood of it may be slowing down a bit might be in the cards. Again, the VIX. I'm going to show you the VIX real quick. The VIX went to 13. Okay. Now it's currently around 14, 15, I believe. So, my opinion, my view, which is everything I'm talking about today, 15 is kind of neutral, okay? 13 was kind of bullish, right? We went to 13 and it looked like we were really going to take off. You see that little tail down there that looks like it might stay for a while? That's what I'd be careful of if I was long the market, and that would be something I'd be careful of if I was looking to trade the market. From the sell side, you certainly don't want that 13 taken out from this week. And I think if you can take out 17 on the upside, it could make a run at 20. And then, of course, if it gets above 20, it could really go. So again, it seems to me, my opinion, that the amount of bullishness out there is huge. Now, there is an offsetting penalty here in that they tell me through some surveys that they've done, some companies have done, that the participation is pretty low. So there should be a lot of money on the sideline if it wanted to come in. But money that's on the sideline may not want to come in because they don't want to take the risk, particularly at the highest price in the history of mankind. So, equity allocation is the lowest since '09. They had a very big drop. Cash levels soar since 2011. Bond allocation is the highest since 2011. That would indicate the 90% or so RSI. And then the record percentage is looking for the dollar to drop. So, when you get that unanimity of opinion, it's always a little bit concerning. Put call ratios haven't gone to an extreme, but they certainly are at elevated levels. And, like I say, this VIX could not get under 13 for very long. It's back above 15. That would be troublesome if I was bullish. And again, the S&P itself, as long as it stays above the 50-day average, which is in the high 2800s, and then the 200-day average in the high 2700s, the bull trend still may very well be intact. There's no doubt about that. But a pullback is certainly not off the table at some point. Again, you got a big week next week with you've got the Fed guys going to be talking, I think, Monday or Tuesday. Then you have got the G20 meeting at the end of the week, and a few other things in the financial area. Business wholesale inventories, I think, are coming out, and some other details as well. But it's going to be a pretty big week in advance of that G20. And so, will there be any book squaring around? Only, nobody knows for sure. Let's just take, and I'll show you a couple of other things that have made me curious of this rally. And one is called the Dow Jones Transportation Average, which has clearly lagged. And it was down 60 points today, and it closed not too far from the low. You see the lows, 10,349. So, the market, I don't know. Is it really going to go through the roof without the transports? It could, and the transport could play catch up. But that, to me, doesn't seem like the norm. And if this thing does start breaking down towards 10,000, I would think that would coincide with a stock drop. The other thing that has me concerned, of course, is the Russell Index. And the Russell Index is down 13 today, right? So that's a pretty good size drop. And you can see here, it looks like it hit a peak last during the week here, and now it's surrounded by some lower highs. So next week's going to be a big week, like I say. If this thing starts deteriorating because of the 90 RSI, because of the moving averages are down in the high 2700s and we're in the high 2900s, there's room to have a correction. That's all I'm trying to say. And then, of course, the non-confirmation from the Russell and the transports is somewhat disconcerting. And again, what is the Fed drop of 0.5 or 1/4% really going to do to the market? The big thing that we have here, do we have retail sales doing okay? You bet we do. Do we have household spending doing okay? Powell just said it was. So that's 2/3 of the economy, consumer spending, right? So what's the drawback here? The drawback here is that inflation and business spending is off. Well, what business is going to start spending like mad in front of a G20 meeting, in front of in the middle of a trade war? Okay. They're just going to be a little more conservative, right? So if you take the G20 meeting and the Xi Trump meeting off the table, if you ever get any kind of resolution on the other, then of course, I don't see where this economy is going to be tanking. Now, gold is telling you something, right? Let's go just take a look at the price of gold, and you can see that I'll show it to you right now, that the price of gold must be telling us something. I mean, look at it. It's not going up a little bit. It's taking off. I can give you a 5-year graph here so you can put it in perspective, but you can see that it's accelerating a bit to the upside. Okay. And I think there's a reason for that. And the reason I think is that the products that have been tariffed are beginning to come into the marketplace here soon, and it's going to come in with higher prices. And basically, when it does that, it may have an effect on the consumer price index and things like that. If it does, and they're cutting interest rates while prices are accelerating, that is what gold loves, because one of the reasons it went up in the 80s was inflation was at 10% and the interest rate was at 4%. And then, of course, gold went from like $100 to $800. And then, of course, Volcker had to hike rates like a madman in order to put the genie back in the bottle. So what am I trying to say here is that everything is telling you something. And again, the Fed dropping interest rates, I'm going to show you that in a minute, because interest rates have already dropped. Yields have already gone down. So again, I don't think until we resolve the trade thing, you're going to find business spending pick up. And there you go. Hang on a second here. This is Barrick Gold. I was looking for the price of gold. Okay, but anyway, that you get the idea. Gold is taking off for a reason. The reason could very well be that they are expecting the inflation numbers to pick up. They're looking for the dollar to possibly drop, and they're looking for the Fed to possibly be stuck dropping rates during a increasing price situation. That's not a very good situation. That's why the smartest thing that they did was just to do nothing and see what happens in July. Because if the earnings start coming out for the second quarter and are looking like all beats, and you start seeing that some of the prices on the CPI and PPI start picking up a little bit, and if you start seeing a little resolution in the trade situation, and you start seeing consumer spending remaining robust, this is going to be a big surprise on the upside. Okay. But, like I say, there's a lot of ifs there. And that's why the Fed's taking the stance of let's see how these numbers come out. Now, I'm going to show you right now the Treasury situation. And when people are starting to talk about these wild, we're going to go to zero interest, which very well anything could happen in this world. I mean, they printed $4 trillion to get the banks out of trouble, and they kept it there for 8 years. I mean, did I think that was going to happen? Of course not, because it was unprecedented. And should it have happened? That's a good debate. Okay, so anyway, the Treasury's up at 206 now. But look where it came down from. And this is just from November, December, right? It came down from 325 to 2.00. So yields have dropped 125 basis points. So do you think the Fed that's up at 2.25, 2.5 could drop a quarter and this thing maybe doesn't do anything? And there's another tale for you this week. I think this week's low in the VIX and this week's low in yields could be very important. So by next Friday, when we get back and talk, I'll have much more information. But if this thing starts moving away from that tail underneath 2% on the Treasury, and if that VIX starts moving away from that 13 print that we saw this week on the VIX, then I think that the wheels of change, or the winds of change, may be blowing a little bit, and they may be catching everybody off guard and leaning to one side of the market. Okay, only time will tell. But again, when you get your gauges up in the 90s on RSI and you are oversold, now come on, I don't know what exactly the moving average is here, but the 200-day moving average has got to be up near 250, and if it is, that could be a good place for it to possibly rally back toward. Okay, and that would catch people by surprise because the whole world is yelling lower interest rates, lower interest rates. The Fed's got to cut. Well, they compare it to Germany. Germany's economy is about under 2 trillion. Ours is over 20. So they are 1/10 the size. And even Japan is only 20% or 25% the size of us. Okay, so comparing their negative interest rates and print till you drop situation to ours is not apples to apples, because we are like comparing, King Kong to a little monkey. Okay, it's just not a good comparison. And ergo, they also don't have a currency that's known as the reserve currency. I mean, nobody's running around with the euro as a reserve currency, and they're definitely not running around with the yen. So the bottom line, and of course, the debt to GDP ratio in Japan is like over 200, getting towards 250, which is just ridiculous. So the bottom line, this, we're supposed to be in the same boat with Japan and Germany, I think is laughable. But, I don't know for sure what's going to happen, and nobody does. But I think, common sense would tell you that comparing yourself to somebody who's only a fraction of your size and then duplicating their monetary policy, that sounds stupid to me. Okay, so what else is going on here? We just went over there. Let's just see a couple of different stocks that you guys might be looking at here. Again, you got earnings, you got the meeting between Xi and Trump, you've got economic numbers coming out, you've got retail sales and household spending looking quite good, you got a GDP number coming out. Now, if GDP is going to hang in between 1.75 and 2.75, going to zero interest, I mean, one of the reasons they're at zero interest is there's absolutely no growth in those economies over there, and that's a problem. So this lowering the interest rate is no panacea. I don't see it that way. It's not going to stimulate inflation all by itself. Now, again, they seem to be running into things like REITs. So let's just see what REITs did here today. I'm just giving you a little rundown on some of the things they've been running into. See a little bit of a reversal today, right? We were up at 91.85 probably a day or so ago, and now we're at 90.23. What does it look like on the graph? It looks like it might be rolling over just a little bit. Okay, these were the enthusiasm trades. What about the utilities? That was an enthusiasm trade. Let's see what that's doing now. Now that's still hanging in there. All-time high was 136.5. We're at 135.71. Still hanging in there, but doesn't look like it would take much to make it go and have a little bit of a drop. So again, if the winds of change are going to blow, it probably blows into the things that people have been loading up on, and they definitely been loading up on the REITs, and they've been loading up on the utilities. Some of the markets that look like they've been trying to make a little bit of a move because of current events is the energy sector. And as I was showing people earlier in the week, that the XLE was trying to make a turn. It just went a little bit under 60 there. It came down off of this little reaction, and now you can see it's above that reaction high of around 62 or so. So obviously where it's trading now is very constructive. We'll have to see if it gets any follow through. The price of crude, had a very big rally this week. A lot of people are jumping into Chevron. They think Chevron is the way to go as the one of the leaders in the group. And let's just see what we got here on Chevron. Okay. Oh. All right. Let's go here. All right. I tell you what, we're at the top of the hour here, and I seem to have hit a button here that. There we go. Okay, we got the screen back. Sorry about the delay. Okay. All right. So anyway, there you can see the chart on the. You can see.